Welcome to another SCORE live webinar. My name is Dave Myers and I'm with SCORE Charlotte. And I'm just awful glad that you folks are here today. We are presenting on Navigating the Legal Landscape by my good friend and colleague, Andrew Bosserman. We'll start in just a moment. I see that we have a good head count today, and that head count currently is at 45. What I will ask everyone to do is to first go into chat and list your name, your business, and location. I'm not sure if we have folks outside of North Carolina or not, but welcome anybody and everybody to attend. And then, as far as questions, I will be monitoring chat while Andrew is presenting, and I'll try to pick up all the questions that are presented in chat. So if you'd hold your questions for a moment or two and let everybody sign into chat with who they are and where they're from, and then the questions can follow, and I'll be able to pick up those effectively. And everyone will be on mute, so please do ask your questions through chat. The presentation deck will be available for distribution and will be sent to everyone attending today's webinar. So that question is one of the more frequent ones. And I'd like to just do a quick presentation of SCORE and who SCORE is. Hopefully a number of folks attending today, if not everyone, knows something about SCORE, possibly a SCORE client and already has a mentor, or there may be SCORE volunteers attending as well. SCORE is a national organization started in 1964. And chapters all over the United States. There are 9 chapters in North Carolina, I believe. And it is proven that SCORE participation has helped our clients start a business successfully and stay in business, increase revenue, more profitability. So the success has been proven. This is just another slide listing several of our regions: Charlotte, Raleigh, Asheville, Western NC, the Piedmont Triad, Cape Fear, Sand Hills, Chapel Hill, Durham, and Coastal Carolina. So it looks like we've got a great crowd in today, and I see 64 people attending. I will stop sharing and ask Andrew Bosserman, our presenter today, to bring up his slide.
Perfect.
So a quick something about Andrew. Andrew is a tax controversy attorney and founder of Boss Tax Law. His practice focuses on helping business owners navigate tax disputes with the Internal Revenue Service, as well as state and local governments. A former IRS agent, Andrew understands what it's like to be on the other side of the table and have unlimited resources to go after taxpayers. He uses the unique insights gained during his time with the IRS to help defend business owners in tax disputes. Also a current CPA, Andrew can run the numbers as well as argue the law on behalf of his clients. He has prepared hundreds of business and individual tax returns, giving him an in-depth knowledge of tax compliance. This is the third presentation by Andrew, and it's backed by popular demand. And I'd like to turn it over to our presenter and guest speaker, Andrew Bosserman.
Well, thanks so much for having me. And yeah, this is a presentation given multiple times before to score. So glad to be back. Thanks for having me again. And in this presentation, I call it navigating the legal landscape because we're just going to go over essentially the basics of, starting a small business from the legal side and also of some things on the bookkeeping and tax side too. Like you heard, I'm a tax attorney currently. My focus is on IRS issues, but I've also done, when I worked at a previous firm, more business formation, operating agreements, things to get your small business set up. So know quite a bit about that world, which a lot is going to be talked about in my presentation. But as we go throughout, feel free to ask questions, put them in the chat. Looking forward to answering all your questions, whether they're on topics about the presentation or even if you have other tax or other questions, happy to answer those as well. But these are the four main things I'm going to be talking about today. We're first going to talk about using a business entity to minimize legal liability. Then we're going to move into the different types of tax classifications for small business. You've probably heard of some of these, but it's a good review to understand taxation. Then a few different compliance considerations. These will be things you can do with the IRS and some things you want to keep in mind. And then going to quickly go over some bookkeeping and accounting basics. So what are the basics you should do when you're starting your small business to make sure you're keeping track of your revenues and expenses and everything properly, so you can understand the numbers in your business, but also, which is important as well, making sure you have good numbers to put on your tax return. But first, let's get into using a business to minimize legal liability. So first, one of the main reasons to have a business entity and why they're created in the first place is to avoid legal liability. So if you are doing business without a business entity, then all your personal assets are at risk, meaning it's just you doing this service. So if you were to hurt someone or have some other sort of issue that you could be sued for, all your personal assets are at risk. This means that potentially your house, money in your bank accounts, cars, everything could be potentially, taken from you in a lawsuit. Also, if you borrow money, you could be held personally liable for business debts, which we don't want. In case your business fails, you could still have to pay those back. And also, if you're not using a business entity, it's going to be more difficult to borrow money or bring in additional owners or investors. If you're looking for a co-founder or trying to grow and bringing in, another partner or investor, you can't do that unless you want a business entity. But with a business entity, generally only your business assets are at risk. That means, hey, my business could fail, but at least, I'm limited to whatever money I put into the business. And that's kind of like what I say in that second point there. I mean, there are some exceptions, but that's the general idea. As long as you're keeping all the formalities of the business and treating it properly, then your amount at risk should be limited to the amount of money you put in the business. But sometimes that can change. Sometimes if you have to get a loan, you sometimes have to sign a personal guarantee, things like that. But generally speaking, that's how it works. And then also, uh, you know, doing business through an entity like a corporation, an LLC, something else, that also helps with your appearance to the public that you're a legitimate business. Because say you're entering into a contract with a potential client and you're just using your personal name, that's a little strange, and they might think, hey, is this person going to be in business in the future, or do they really know what they're doing? So having an LLC or a business entity helps with that as well. So now I'm going to talk about three possible choices, and these are really the three main choices. It is possible you could also form like a general partnership or maybe do business through a trust or something, but that's pretty rare and you probably wouldn't choose that anyways. But I'm going to talk about the difference between a sole proprietorship, a corporation, and a limited liability company. So the first option is a sole proprietorship. So this is the default if there's one owner and no entity is formed. So essentially, if I decide to just start doing business in my personal name, so I go out and hold myself out as Andrew Bosserman, attorney, but don't form an LLC, then I have a sole proprietorship. But what we don't like about sole proprietorships is that you get no personal liability protection because you haven't formed an entity. You're doing business in your own name. So that means whatever you're doing, if something causes liability, then if you're sued, then all of your personal assets are at risk. So sometimes people start as sole proprietorships just to test out a business, but very quickly you should move into some sort of entity. And oftentimes I would recommend just form an entity. It's pretty easy. Do it from the get-go so you don't have any potential, liability issues. Um, and it's also easier to get separate bank accounts and things like that. Another option is a corporation. So a corporation is good because you get limited liability, personal liability protection. And in a corporation, it can have one or multiple owners. These are called shareholders. So if you have ever owned a share of stock, say in Apple, Google, Microsoft, any publicly traded company, you've been a shareholder in a corporation. You're an owner, even but in public companies, very tiny fraction. Uh, but the things we don't like about corporations is that there's lots of corporate formalities that must be followed. So, for example, you have to have a board of directors and regular meetings, and you have to keep minutes, which is a written record of what was discussed and decided at those meetings. Um, Oftentimes in small companies, you might be the entire board of directors, or there's one or two people. Um, Corporations were popular years ago before limited liability companies (LLCs) were created, but now they're not really used as much anymore. All the publicly traded companies are corporations, but most businesses formed today are going to be formed as an LLC, which I'm going to talk about next. And we also dislike corporations because they're just not as flexible. LLCs, you have you can allocate profits and stuff flexible, and there's just not as many corporate formalities. So corporations are great because you get limited liability, but the reason why most people don't form them nowadays is just because of all the ongoing formalities that make it just more onerous and time consuming to manage. And then the final option, which is probably what 90% or more of businesses that are formed today create, are limited liability companies. So, same as a corporation, you get limited liability, you get protection from personal liability. They can also have one or multiple owners. Uh, for LLCs, the owners are called members instead of shareholders, but it's the same idea. You're an owner. The thing we like about LLCs, they're extremely easy to form and maintain. You just file a document with the Secretary of State. You should also create what's called an operating agreement. I'll talk a little bit about that more later. But there's no ongoing requirement to have like a monthly meeting of a board of directors. You don't even need to have a board of directors. Just the individual who's the going to make decisions on behalf of the LLC is called a manager, and it's flexible. You can essentially, in this operating agreement, decide to govern it however you'd like to, as long as it complies with the law, and the law is pretty flexible too. So, just kind of in summary, sole proprietorship, that's just doing business without an entity, not recommended. Corporations, you get limited liability. I mean, it's better than a sole proprietorship, but you have all these downsides of corporate formalities. Um, but then LLCs are really the preferred entity nowadays just because they're easy to form and maintain, flexible, not as many corporate entities, and you still get all the benefits of personal liability protection. So that's a comparison.
Andrew, those are
Yeah.
some Andrew, those are some great comments, and I see that we're now up to 88 participants, which is great. I'd like to throw out just two questions that are kind of relating to that just prior presented information. one of which may have been already answered, but if you could address it specifically from Asheville, I'm especially interested in sole proprietorships for the purpose of providing consulting and relating services. Well, Andrew, I would take that would you recommend a sole proprietor to provide consulting or related services or some other structure?
I mean, I would still probably form an LLC. It's hard to know without having more details. And also, I'm going to get into this, but there is also a difference between the business entity and the tax classification. So, what I've been talking about here is the legal entity, talking about protecting you from personal liability. This is very different than your tax classification because there's also a tax classification known as sole proprietor, and that goes along with S corps and C corps. But here, this is legal, so you might call the sole proprietorship. I mean, if it's just going to be you in business providing consulting services, um, I would still probably form an LLC just to keep everything separate from your personal name. Um, but that's how I do it without knowing more information.
Okay, one last question, then we'll move on to the next section. And this question is: I have a day job and generate income outside of my LLC. Assumably, already has an LLC established. However, my LLC does not yet generate income. Is it possible to write off expenses even though I have not generated income from the actual LLC?
So it's going to depend on I guess starting off, just because you have an LLC doesn't necessarily mean you can write off expenses. That's kind of some misinformation that's out there on the internet. It's like, oh, start an LLC and you can immediately write off anything. That's not true. What matters is whether you've started uh, in business. So the real question is, you've started an LLC, but is your whatever business you've chosen to get into, are you actively in business yet, or are you in the startup phase? If you're in a startup phase, you can't deduct all your expenses, you're limited. But once you start business, then you can deduct your expenses. The fact that you haven't generated any income, that's a factor the IRS will look at, and it's good to bring in income. I'd say once you bring in income, you're definitely in business. But before you start generating income, there's always the question of whether you're in business yet. If you're actively trying to find customers, selling, again, I don't know what your business is, then you're probably in business. But it gets into if you're just in the startup phase, investigating kind of what business I want to go into or how to generate income, then you're probably not to the point where you can immediately deduct all your expenses.
So questions are starting to flow in quite heavily, but I think we need to move on. Andrew, I believe you'll be discussing tax selection and designations on future slides. Is that correct?
Yeah, that's right. And I can see the questions too. So
Okay, good.
we'll cover S corps and talk about that, and then we can always circle back and answer anything I don't cover.
Very good. Any comments on foreign LLCs?
I mean, I think generally, well, I'm not an asset protection expert. Some attorneys will advise, set up a Wyoming LLC or in a different state because maybe the laws there are a little more favorable for asset protection. I'm not sure it's always worth the hassle unless you are in some sort of industry where it's likely you're going to be sued. Generally, if you're in North Carolina and going to do business in North Carolina, it's easiest just to form a North Carolina LLC, especially if you're just starting out. I mean, I would not try to make it more complex than it needs to be if you're just starting your business. The people who say like incorporate in Delaware or Wyoming or other places, that's kind of like advanced strategies for advanced business owners when you have something to protect. You can always like change the domicile of your entity down the line if you need to or other things. But if I was just starting out, I would just form a North Carolina LLC.
some great questions coming in, and they continue. And Andrew, how about we move on to the next subject? And depending on timing, we can circle back to some of these questions.
Okay, that's perfect. And before we get into tax classification, I have one more slide. Let's see. Other kind of important to dos when you're forming an entity. You're going to want to draft an operating agreement if you're forming an LLC, and that is essentially a contract between all the owners of the LLC and the LLC itself, essentially saying, hey, how are profits going to be allocated? Who's going to make decisions? Who can sign legal documents? That's important to have. You're going to want to get an employee identification number, separate tax number, so you don't you use it on legal documents. And if you ever hire employees or pay contractors, you'll need it. You want to set up a separate business bank account and run all your income and expenses through there. You're also likely going to want general liability insurance. If you're going to be making taxable sales, you'll probably need a sales tax number. And also, you'll want to set up a bookkeeping and record keeping system. And I'll talk a little bit more about bookkeeping and record keeping later on. But these are all things, and this is an exclusive list, but main things to think about. You want to get these in order when you're setting up your business and forming your entity. So that was going over the legal side, the legal entity, but now we're going to talk about small business tax classification. So since I said, most people are going to form an LLC, and I'll assume most of you, if you have an entity, are likely an LLC. You have four possible choices for how you could be taxed, and this is under federal tax law. You could be a sole proprietorship, you could be a partnership, you could be an S corporation, or you could be a C corporation. So the first option, sole proprietorship. And this will apply if the LLC only has one owner. This is the default status. So if I form an LLC for a business and I don't elect to be treated otherwise, I'm going to be treated as a sole proprietorship on my tax return. And essentially, this is sometimes referred to as a disregarded entity. So the IRS doesn't really look at the LLC. They just treat it as I'm doing business in my own name. But again, this is for tax classification. So because I formed the LLC, I still get all the personal liability protection, but it's just for tax purposes. It's treated as if kind of I'm doing business in my own name. The thing we like about this is that it's easy. You just report your income and expenses on your personal tax return. Generally, it goes on a Schedule C, which you may have prepared or have heard before. And also, you can also elect these other tax statuses in the future if desired. So if you're starting an LLC, only one owner, it's very easy to start as a sole proprietorship, and you can always say elect S Corp status in the future if desired and makes sense for your situation. Sort of the second option for tax classification is a partnership. So if you have an LLC and you form it with multiple owners, and those are called members, remember, for an LLC, then the default status is going to be a partnership. This does require a separate tax return because you have to file a separate partnership tax return. But what's nice about partnership taxation is that you get flexible ownership and profit allocation. So, for example, you might two people might contribute money to an LLC, tax as a partnership, but maybe you want to allocate most of the losses to one owner and the profits to the other owner, just maybe for a tax situation to make sense for that. You can do that oftentimes in a partnership, or sometimes you can give equity to employees easily, called a profits interest, that maybe they get paid out if you sell the company. That's very easy to do in a partnership, not so easy to do with corporation taxation. So partnerships are great if you have multiple owners because they're very flexible. The third type of tax classification is S corporation. So you've probably heard of this. This is very popular It does require a special election and a separate tax return. So there's no default S corporation. You either have to be an LLC or a corporation and file a form to elect S corporation status. And the main benefit and why you hear about this is that you may be able to save some employment taxes. Um, and this is because when you have an S corporation, you can pay yourself a salary, but then any money you make above the salary, you can then distribute to yourself as essentially an owner's draw. That's part of the profits, but that's not subject to employment taxes. So, really, the main benefit of an S corporation is that oftentimes you're able to save some employment taxes. But oftentimes, this likely doesn't make sense until you have at least $100,000 in net profit, just because you have additional costs to, say, uh, pay an accountant to file a separate return. You have to run payroll, and you have to do the math to make sure it makes um, sense for the taxes that you're saving. Also, S corporations have ownership restrictions. So S corps can only be owned by U.S. Individuals who are U.S. citizens or these two special kinds of trusts. They can't be owned by like another partnership. They can't be owned by someone who's not a U.S. citizen. So that does restrict it sometimes. If it's a small business closely held by U.S. individuals, then it's likely not a problem. But as the business grows bigger, oftentimes this can become an issue. And that's really why no really big businesses are S corporations. There's also a limit. You can't have more than 100 shareholders. So that's S corporations. And then there's also C corporations. So, and again, if you're an LLC, this requires a special election and a separate tax return. I'll say most small businesses are not C corps due to double taxation. So in a C corp, and all big publicly traded companies are C corps. But what happens, there's double taxation. So the corporation itself pays income tax on its profits, and then it distributes its profits to the shareholders via what are called dividends. But then the shareholders themselves pay tax on the dividends. So double taxation. Um, Although the tax rates have been reduced some recently, oftentimes small businesses will still pay a little bit more in tax as a C corporation than, say, being an S corp or a partnership or a sole proprietorship. Um, but there is a benefit if you are thinking you're experiencing rapid growth and is going to sell your firm for a good amount of money in the future. There is this provision in the tax law. It's called Section 1202 stock. I won't go into it too much, but you can exclude a lot of the gain from a qualifying startup under that section. So it's possible if you were to sell your company in the future, you might not pay any tax on it at all. And that's what a lot of these tech companies, they organize as C Corps, especially for that purpose. So I'm sure we have some questions. I'm going to put all the classifications back up on the screen. Um, and then we can go through the questions and kind of answer anything else about tax classifications.
And I'll thank you, Andrew. Again, this is very interesting information, and that's kind of indicated by the number of chats and attendees that we have. And I'm just going to select some of the questions that have been presented that relate to this. And I'm going to paraphrase a little. The question is the entrepreneur has personal equipment that he is using for business, and he plans to pay himself all the net income, but he expects the LLC to have minimal or no assets. And his question is, if I formed an LLC, what would actually be up for grabs if he were sued? And I think the basis of that question is, if the equipment is personally owned, there may need to be some rental by the LLC back to the individual, but would those personal assets or equipment that he's using for business purpose be available to creditors?
So if you're doing everything properly, they shouldn't be available to creditors. But you would need to, like Dave alluded to, you'd need to make sure there's a uh, rental agreement in place between like the LLC and yourself for a fair market value of renting it. Because what you don't want to do is commingle or um, not respect corporate formalities. And that means not, you should treat the LLC or your business as if it were a completely separate third party person. So that would be, not paying personal expenses out of the business bank account, not just letting them use personal property. Because if that happens and you get sued, the courts can say, um, it's called piercing the corporate veil, but essentially it says, hey, we can hold the owners individually liable. And also in some instances, if it's just like an LLC that's really using other assets and stuff like that, they can sort of disregard it because it's sort of a sham entity. It's, you have it out there, but you're not really using it like it should be. But um, if you do have a rental agreement in place that's proper and are respecting all formalities, then the assets shouldn't be up for grab if that operating LLC is sued.
Great. And it's, to put it in informal terms, dot your I's and cross your T's. Make sure that you have everything in place according to the rule book, is what I'm hearing, Andrew, if that's the case. And one or two other questions, one of which is somewhat specific about securing a name through the NC Secretary of State. They have a name selected. The name was used in the early 2000s, but it currently shows dissolved. Since it's dissolved, is the name still available for grabs if it is not currently active under the North Carolina Secretary of State?
Yes, it should be. So once it's dissolved, they should let you um, use it. The other thing is you can always, you should also check DBA names, and those are called fictitious names in North Carolina. But you can always form an LLC and then do business under a different name. So, um, yeah, I could form Andrew Bosterman LLC, but do business as like any name as long as no one else is doing it. But yes, generally when it's dissolved, you can use that name. So you should be good there. But when you can file the LLC articles and the uh, North Carolina Secretary of State always checks to make sure essentially the name is available. They run their own checks before they accept them.
Thanks, Andrew. Let's get two more quick questions and then advance to the next slide. So, this, you had mentioned something about being a citizen, and the question is, can you restate the citizen part? One of my partners is not yet a citizen.
Yes. So citizenship only matters for S corporations. So generally, you have to be a U.S. citizen to be an owner of an S corporation. But if you're a different classification, that doesn't matter. It's just that citizenship comes up for S corporations, U.S. individual. It also going to. I can double check. I forget if permanent residents, say you have a green card, if you can own an S corp or not. Um, they might also be able to own S corps. I just forget that nuance off the top of my head right now. But that only applies for S corporations. If they're not a citizen or a personal resident, they definitely don't qualify to own an S corp. But again, that's only applies to S corporations. So you could be an LLC taxed as a partnership with your partner. That'd be completely fine. Could be a C corp. That's completely fine. The whole citizenship piece only comes into play for S corporations.
Thank you. Let's get one more, and then I think a lot of the current questions will be addressed by your future sections. But this last question: what is the difference between a self-employed tax versus taxes taking out of a check as an employee?
Okay. So, um, if you are self-employed, say you are a sole proprietorship, you're going to have to pay what's called self-employment tax on your profits, and that's 15.3%. So that is so that covers FICA taxes, which is Social Security and Medicare. And you have to pay all 15.3%. But if you're an employee, you only pay 7.65%, and then your employer pays the other 7.65%. But if you have your own business and are essentially employing yourself, you really net out the same because you're just paying 7.65% personally, and then your business is paying the other half. So if you're it doesn't really make sense to if you're like the sole owner of a business to put yourself on payroll normally, unless it's for an S corporation and you're trying to save some employment taxes. But for example, if you're a tax as a sole proprietor, like you end up the same place if you were to put yourself on payroll, um, because you you're paying the same amount of tax either way. It's just really gets into the rates stay the same. It just gets into who's actually paying what part of the employment taxes.
Again, Andrew, apparently the subject matter is very interesting and applicable to a lot of our attendees because we got a number of questions still coming in. But please move on to the next slide.
Okay. So now we're going to go briefly into kind of some compliance situations. So one thing I recommend for all business owners, and this is how you can detect most issues, is to review your IRS transcripts regularly, as well as review your bank statements regularly. So I recommend this because pretty much almost all embezzlement, fraud, CPA negligence I've seen could have been discovered earlier if these two steps were followed. So, what are IRS transcripts? This is essentially all the information the IRS has about you. You can see, the date you filed the tax return, how much they say you owe, when you made your tax payments. And you can also see all the 1099s, W-2s, and other information documents that have been filed in your name. The important thing, you want to review those because, say, for example, if you have a business, I have a client currently who ran a business. He had his CPA file and pay all his payroll taxes for him. Unbeknownst to my client, the CPA got sick. It was affecting his mind. He filed and paid taxes late, even though he was telling my client, yeah, everything's good. I've paid it. And the CPA eventually died during COVID. New CPA took over. Records were a mess. Pulled transcripts and discovered. He told my client, "Hey, did you realize you've been assessed $800,000 in IRS penalties?" And he actually already paid most of them because the CPA was paying them with his money. But that could be detected by reviewing your IRS transcripts. You'd see all those penalties. Fortunately, I've been able to get at least 200,000 waived and 200,000 back already, and working to get more back. But definitely try to protect yourself by reviewing your IRS transcripts and also looking through your bank statements regularly. You should be able to detect any issues, and also just if you're looking at your bank statements regularly, you'll just see what's going on, and anything out of place should jump out to you. And then the other thing I want to talk about, which is important, is 1099 and information reporting. So this law has changed a little bit in the past year. So when you must issue 1099s, and this is a 1099 NEC for non-employee compensation. So the threshold used to be $600. So if you paid $600 or more to a contractor or a freelancer or some other business that's doing work for you, and there was an exemption, you had to file a 1099. For 2026, fortunately, that jumps up to $2,000. So that should mean a lot less 1099s are being filed. Um, Also, so it's generally required, if you're paying an individual, sole proprietor, LLC, if you're paying a corporation, it's exempt. And also if you're paying um, the contractor via, say, PayPal or credit card, those are exempt. But if you are making, say, cash payments, writing checks to any contractors, you definitely need to keep track of this because you might need to issue a 1099 to them. And the deadline for issuing that, it's already passed for this year, but just remember in future years that January 31st is when you must send copies to recipients and also file with the IRS, because these penalties can be pretty steep, anywhere from $60 to $680 per form for late filing. And that's based on how late you were, plus whether you like intentionally disregarded it. And for certain businesses, they have to file a bunch of 1099s. For example, I currently have a client that's a logistics company, but they subcontract out all of their work, and they have to file, I don't know, over 1,000 1099s, and there was an issue with them filing them late. So those penalties can really add up. And one pro tip to remember, a W-9, that's the form you collect from a vendor to get their either social security number or employee identification number. Generally get that before you pay because you have it. And then if you have to file a 1099, you have all the information. Oftentimes what happens is that you have to file a 1099, you reach out, in January, right before you have to file it, and then the vendor doesn't get it to you, or it's last minute. So it's always easy to just get that before you pay if you think you may have to file a 1099 for someone. So just there's only two things in this section, just about transcripts and 1099s. So happy to quickly pause here if there's any questions about that.
I see a quick question that surfaced specifically on the 1099, Andrew. If we pay someone via Zelle, is it exempt from reporting on 1099?
That's correct, because what happens is that Zelle is going to issue the person you're paying um, a 1099-K, assuming you paid them. I think they only do it if you indicate business. I don't think they do it for personal. So if you're making business payments, you should check that it's for business. That way the reporting is proper. But yes, if you're paying someone via credit card or other electronic payment method like PayPal, Venmo, Zelle, then those are exempt from 1099s.
Andrew, would you like to pause for a moment and address some of the questions or continue?
Let's see. Oh, I did see. This is a good question. So I do see a question that says someone asked, where do I find my IRS transcripts? So if you go to irs.gov, if you haven't, you can create your own online account, which I recommend. And then when you go in there, you can see um, there's an option to pull copies of your transcript. So that's the easiest way to get your tax information. You can also make payments through there and see things about your return. Sometimes the IRS will also upload any copies of correspondence they send you, and they keep adding functionality. So it keeps getting better and better. So that's the easiest and quickest way to get your transcripts. There are also options to get them by phone or faxing a form or mailing in a form, but through your online account is the easiest. Also, you can have a CPA or attorney or another tax professional get them on your behalf. You just have to sign a form for them to do so. For example, I almost all my clients I have a power of attorney form on file so I can pull their tax information. But if you're just looking to get them yourself, the easiest way is through your online account at irs.gov. So then I'll move on. We can always go over a lot more questions at the end, but let's go through just some bookkeeping and accounting basics. So organized record keeping, extremely important because, efficient tax reporting, you'll have an accurate numbers for future planning. If you're ever thinking of bringing in investors or borrowing money from a bank, then they'll want to see financial statements. Um, Also, less stress like during tax time or an IRS audit. If you're organized, then it's going to be easier. And for my time when I was an IRS agent, many assessments I saw for additional tax, it was essentially taxpayers couldn't substantiate their expenses. They didn't keep receipts, they didn't keep organized records. They probably paid the expense that was deductible. It was just they couldn't prove it or couldn't substantiate that was for a business purpose. So that's why this is important. Here are three possible bookkeeping systems. There are a lot of options out there, so this isn't exhaustive, but I just pulled three options that I've had some familiarity with. So Excel, when you're just starting out, oftentimes see people just start making a spreadsheet. It's inexpensive because it's essentially free. The problem is there's no built-in reporting, there's no built-in checks and balances. It's not true double entry accounting. So while it's great to add up numbers and prepare reports, you should use an actual bookkeeping system. That way you can reconcile your bank statements, make sure everything is included. Excel is just kind of inadequate as your primary bookkeeping program. A very popular and probably the most popular bookkeeping software out there is QuickBooks. And I think it's a good choice for established businesses. The one down, it's very good. It has, it easily integrates, it has good reporting tools. You pretty much do almost everything you need until you get to be a massive business. But the downside is that it's pretty expensive just for a standard plan. I just looked up updated costs for it, and it's the standard plan with most functionality you'd need is starts at $75 a month. So when you're starting out, that can be a decent chunk of change. There's also an option, I've used it before, Wave Accounting. And this one is free. There's also a minimal cost of like just under $200 a year. Reporting is generally good enough. It also has integrations to pull in accounts. So there are other options out there. I just offer Wave as a good one that's cheaper than QuickBooks, but still offers a lot of the same functionality. There's also other ones you may have heard of, like Xero, Zoho. You can also check those out too. But I would recommend definitely using a bookkeeping system such as QuickBooks or Wave. Don't just rely on an Excel spreadsheet because you can easily miss transactions or just make errors. There's no built-in checks and balances or reconciliations. Some bookkeeping best practices. I always recommend establishing a regular bookkeeping schedule. So at least monthly, you're going to want to enter income and expenses, pay your bills, reconcile bank statements. Also, make sure your receipts and documents are organized. So with cloud storage nowadays, it's super easy. For example, when I get a receipt from something, I either scan it or just take a picture with my phone, upload it, and it's saved in OneDrive, which is what I have for my business. Also, for bookkeeping, you're going to want to clean up the chart of accounts. So chart of accounts is all the accounts you can book income and expenses to in your bookkeeping system. There's lots of unnecessary accounts they come preloaded with. So for example, if you're a sole proprietor, don't have any employees, like just delete all the accounts that talk about wages or employee benefits. You can always add those back later if you hire employees, but you just want to prevent booking things to the wrong account. Also rename the accounts with useful titles tailored to your business. And then also what's important is maintaining a mileage log. So when I was an IRS agent, we audited car and truck expenses all the time. And it's just because the rules are confusing. People might try to abuse it some, but if you are driving your car for business purposes, the IRS says you need to keep a mileage log. So log your trips as well as take a yearly odometer reading so you can prove total miles on your car. Because if you ever get audited, they're likely going to ask for that. And now I'm just, common question is how long to keep records. So as a background, statute of limitations on a tax return, meaning how long does the IRS have to assess additional tax against you? It's 3 years from the later of the date the return was due or actually filed. So as you're filing your 2025 return, if you file it by April 15th of 2026, the IRS has until April 15th of 2029 to assess any additional tax, audit you and assess any additional tax. There are some exceptions, say if you omit too much income or are being fraudulent, but I know none of you out there would do that. So 3 years is normally how long you have to wait. But if you have unfiled returns, the statute of limitations period does not begin until the return is filed. Oftentimes, I help clients who haven't filed for a period of years for whatever reason. And the first step is always get the returns filed, get that 3 year clock ticking, and we can deal with the amount that you owe or any other issues after that. I recommend keeping tax returns and W 2s forever. And one reason is for Social Security purposes. Social Security makes mistakes, and sometimes you have to provide either your tax returns or W 2s to confirm with them how much you paid into Social Security. All of their documentation, generally like 7 years is a recommendation. Sometimes you might need to keep documentation for, say, like if you have a bank loan, sometimes there's certain purposes. Also, you may have to keep documentation longer if it pertains to, say, future income or deduction. So, say I bought a piece of real estate decades ago and I'm now just selling it. I would still need to keep records related to how much I bought that real estate for, like the settlement statement, um, things like that, to prove my basis in that property. So, don't just think that, oh, this is a really old record, I don't need it anymore. If I'm going to have to report something related to it on my tax return in the future, then I need to keep it. And then just a quick overview of financial statements. The two main ones, income statement and balance sheet. Income statement essentially calculates net profit. How much did I make? This is just a random example of a hypothetical income statement for someone who is an artist who's selling paintings but also teaching. Net profit is simply revenues minus expenses. How much do I have left over after I pay all my expenses? This is important for your tax return because it's the main financial statement that's used to calculate your tax. So essentially, you're going to owe income taxes based on your net income with some adjustments, because not all expenses are fully deductible for tax purposes. And then you also have a balance sheet, which shows assets, liabilities, and equity. And this shows who owns what in a business. So assets are like hard stuff that the business owns. It can be cash, inventory, equipment, like in this scenario. And then you have liabilities and equity. Essentially, those are saying who owns the assets in the business. Liabilities are claims by non-owners. So like if you had a bank loan, that could be a claim to the assets by a non-owner. But then equity is claims to the assets by owners of the business. And if you don't have a bank loan or anything else, generally, most of it is going to be in equity. But anyways, that is really just some quick bookkeeping considerations. I'm going to get to the last slide. One thing, so I actually recently came out with a book. It was just published recently. It's called the IRS Survival Guide. It goes into more of the IRS side. So it doesn't really go into starting a business, but more so, hey, how do I deal with the IRS when I have a problem, or how do I, prepare to avoid a problem? It goes through a lot of stories I had when I was at the IRS and also working with other clients. And I'm actually offering, you can download a free PDF copy of the book. You can just use the QR code or go to the website. Just want to get this book in as many hands as possible. You can also, if you prefer hard copies or Kindle, there's also a link to buy it on Amazon, but would love for you to check it out. Feel free to, scan the QR code or check out the website. You can also, it's if you go to my website also, which the link will be on the next page, you can also find it. But anyways, I'll pause here and we can go over, any questions anyone else has for the kind of remainder of the time we have together.
Great content again, Andrew, and thanks so much. One comment that I would like to make as a certified mentor for SCORE, I have a number of clients, and going back to some of your accounting comments, a number of my clients, they have a friend or a paid bookkeeping service or someone that's doing their books, and I ask them questions about their numbers, and they just don't know the numbers. They don't know how much they have sold, don't know how much they have spent. So my suggestion to all entrepreneurs is you got to know your numbers. You might not need to know the detailed nitty gritty if you outsource that bookkeeping or accounting, but you need to be familiar with your numbers. Any comment on that, Andrew?
No, I agree. You just can't like abdicate financial responsibility to your bookkeeper. And you're not going to be an expert, but you at least need to know the basics of like what an income statement is, what a balance sheet is, how bookkeeping works. You don't necessarily have to do it yourself, but you should still have a baseline understanding so you can understand the financial reports and know what's going on in your business.
Agreed. One earlier question I didn't want to lose sight of, I thought was a little interesting, but when you had mentioned the corporate veil of protection earlier, the question is, so far you have discussed liability protection if the company gets sued. What happens if I, the individual and owner, I'm assuming, if I get sued, is the business protected from people attempting to sue me?
Yes. Well, they could. So if you get sued personally, they could look. They wouldn't necessarily generally be able to get like the assets of the corporation, but say you were to owe money, they might be able to get money you take out of the business. There's a lot of different things that go into it. So since it's a separate entity, it's kind of protected from them just taking assets. But if you regularly earn an income from the business, they might be able to use some of that to satisfy any money you owe. And this, I didn't really talk about it earlier, but this is another reason why insurance is so important. So there's general liability insurance on the business side, but also on the personal side, like having an umbrella insurance policy just to protect against um, general liability claims, whether, someone comes over to your house and slips and falls, or are in a car accident or something else, your dog bites someone. Normally, like an umbrella policy covers that. And it's an important thing that oftentimes people overlook, but the legal entity on the business side helps for liability protection, but it's also good to have insurance because it's also a backup, and you probably should have that on the personal side as well.
Good. Quick comment. I see a Susan Marino has a hand raised. We are unable to unmute and go live. So if you'd like, please pose the question on chat, or you can contact Andrew directly, or a local SCORE chapter. Andrew, would you like to select a couple of the questions if you're monitoring, and if any jump out that would be of wider interest, maybe address those?
Yeah, let me scroll through. Someone asked, are digital copies of your tax returns okay? Yes, you don't need to keep hard copies. The IRS will accept digital documentation. I just keep copies of PDF tax returns and everything else. So that's all you need to do. Someone else asked the question, can bank statements be used as a way to show proof of a purchase to the IRS, and do you need a detailed original receipt? So the detailed original receipt is best, but in my experience, oftentimes the IRS will accept, say, a credit card statement or a bank statement so long as there's enough detail to show what the transaction was for. So the receipt's better because it shows exactly what you purchased. Because on the credit card statement or bank statement, it might just show I went to Walmart and bought something. And the issue could be proving that it's for business purposes rather than just you went and bought personal groceries at Walmart. So, yes, it can be accepted, but the more detail you have, the better. Let's see.
Here's one, Andrew. Is the IRS account under an individual's name or the business entity if you are a single member LLC?
It would be under your name because all your income and expenses, if you're a single member LLC, taxes, sole proprietorship, that's just reported on your personal return. So that would just be under your personal name. And there are two different types of tax accounts. There's individual and business. So for individual, that's your individual taxes, as well as if you file like a sole proprietorship, Schedule C on your tax return. If you have a business, then you'd have to set like that's taxed as a partnership or an S corp. You'd have to set up a separate business tax account. They keep adding more and more functionality. So I know it's not always available for all businesses, but I think it is available for most businesses now.
Several other questions, and I'm trying to respond to a few that I can. There was one about liability a ways back, and let me see. I have a licensed home care agency out of my home. What are some legal concerns I should keep in mind for the home care agency? I do have a basic insurance plan. So, is there increased insurance or considerations outside of insurance from a legality standpoint, Andrew?
I mean, the basics of having a legal entity. Also, if you are hiring employees, generally there's separate insurance to cover like any acts by the employees. So you want to do that. And then if you have employees, then you'll likely want employment agreements and kind of all of that set up. So not I don't think there's anything maybe super specific, but it's covering the bases in terms of having a legal entity. Sounds like you have some insurance already, looking into whether or not you might need extra if you have employees, and then just dealing with all the standard employment issues, having an employment agreement, things like that for if you have employees.
A question that's actually surfaced in with some of my clients, Andrew, and that is what's involved in changing from a single owner or single member LLC to a multi-member. This question happens to state three, but from what's involved in changing from single member LLC to multi-member LLC, and it says all in NC or one in Florida. So, do the members' geographic location and main residence enter that picture? So, what's the transition involvement, and is their main residence impactful?
Yeah. So when you're adding members to an LLC, you have to, there's generally some legal documents you have to file. You generally have to amend the operating agreement to show that the LLC added new members, and there may be an agreement between the LLC and the new members agreeing to admit them. So pretty easy from that standpoint. It's pretty basic legal documents. You might also have to change the tax classification Because if it was a single member, you might just be a sole proprietor. And if it becomes to a multi-member, it's going to default to a partnership. So you might have to elect S corp status if you'd like to. In terms of the state doesn't matter where the members are. It matters for them because they might have to pay income taxes on their share there, but nothing really the LLC would have to do unless they're doing business in both of those states as well. So it's pretty, there's not too much involved, just some basic legal documents and possibly changing some filings with the IRS.
Well, this has been great. I see we've gone a little long. There's still a number of questions in the Q&A box and the chat box that we haven't addressed. Hopefully, Andrew's inclusive presentation has addressed some of these questions in some manner. The presentation will be distributed to all attendees. And if there are additional questions, you're welcome to reach out to Andrew at his contact information on the screen, or go to a local SCORE chapter or a SCORE mentee. Andrew is one of our ongoing presenters, and I really feel lucky that we do have access to him. In closing, I would like to share one additional screen with some additional information about SCORE. And thank you all for attending, and hope to see you at future webinars. Thank you, everyone, for attending. Andrew, thanks again, and I look forward to chatting here soon. Have a great day.
Great. Thank you.